Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KKR Real Estate Finance Trust Inc. Annual Report. KKR Real Estate Finance Trust Inc. offers a range of businesses and services that cater to the commercial real estate market. The company's primary focus is on originating and acquiring transitional senior loans secured by commercial real estate assets in the United States. This includes the origination and purchase of credit investments related to CRE, such as leveraged and unleveraged commercial real estate loans. The company provides various services that support its core business activities. These include loan origination, acquisition, and management of commercial real estate assets. By offering a range of financial products and services, KKR Real Estate Finance Trust Inc. aims to provide investors with diversified investment opportunities in the CRE market. The company's tax-efficient structure also allows it to distribute at least 90% of its taxable income to stockholders, providing them with potential benefits from their investments. The company's services can be summarized into several key areas: origination and acquisition of transitional senior loans, purchase of credit investments related to CRE loan management, and servicing investment opportunities in the CRE market overall. KKR Real Estate Finance Trust Inc. provides a range of businesses and services that cater to the needs of investors and commercial real estate developers in the United States. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of KKR Real Estate Finance Trust Inc. (KREF) has dropped in the past year due to several factors that have impacted the company's performance and investor confidence. One major reason is the decline in interest rates, which has reduced the attractiveness of the company's high-yielding debt investments. Additionally, changes in market conditions and economic uncertainty have led to a decrease in demand for real estate investment trusts, REITs, like KREF. Another factor contributing to the drop in stock price is the company's exposure to specific sectors or geographic regions that are experiencing downturns. For instance, if KREF has significant investments in areas such as retail or office buildings, which have been struggling due to shifts in consumer behavior and remote work trends, it could negatively impact the company's financial performance. Furthermore, regulatory changes or industry-wide developments can also affect a REIT stock price. For example, changes in tax laws or regulations governing REITs could alter their business model and profitability, leading to a decline in investor confidence and stock price. Lastly, internal factors such as management decisions, operational inefficiencies, or accounting issues can also contribute to a drop in stock price. If KREF's management team makes strategic mistakes or fails to adapt to changing market conditions, it could lead to decreased revenue and profitability, ultimately affecting the company's stock price. In summary, the decline in stock price of KKR Real Estate Finance Trust Inc. is likely due to a combination of external factors such as interest rate changes, market conditions, and regulatory developments, as well as internal factors like management decisions and operational issues. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Interest rate changes, credit risk, hedging activity, regulatory changes, and tax provisions governing REITs all play a significant role in determining revenue fluctuations. In addition to these macroeconomic factors, the performance of specific business segments also contributes to revenue growth or decline. The origination and purchase of credit investments related to commercial real estate, net income attributable to the company, and the performance of its current portfolio of leveraged and unleveraged commercial real estate loans are all critical drivers. Interest income from commercial real estate loans held for investment is another significant factor, as is the allowance for credit losses on these loans. The gain or loss on sale of financial assets, including loans and securities, also impacts revenue growth or decline. Finally, revenue from real estate-owned operations, such as rental income and reimbursement of property operating expenses, rounds out the primary drivers of revenue growth or decline. By understanding and analyzing these key factors, a company can better anticipate and manage its revenue fluctuations. Net income and profit margins changes. A summary: the net income of a company underwent significant fluctuations between 2023 and 2025. In 2024, the net income increased due to rising interest rates, but this trend reversed in 2025 as declining interest rates led to a decrease in net income. The decline was further exacerbated by hedging activities, which were expected to negatively impact net income. In contrast, profit margins experienced a more pronounced decline. Despite expectations of an increase with rising interest rates, the actual decrease in net income resulted in a significant drop in profit margins. The net interest margin decreased from 28.3% to 20.1%, while the operating profit margin dropped from -4.7% to -11.2%. The primary reason for these changes was the interest rate environment. Rising interest rates in 2024 led to increased net income, but declining interest rates in 2025 resulted in decreased net income and profit margins. Additionally, hedging activities and other factors such as decreased demand for certain properties and defaults by borrowers or tenants also contributed to the decline in net income and profit margins. The company's financial performance is a testament to its ability to generate consistent and substantial operating cash flows. Over the past 3 years, the company has demonstrated a remarkable trend of producing positive operating cash flows. In 2023, the company recorded an impressive $181,771 in operating cash flow, indicating a strong foundation for future growth. The following year, 2024, saw a slight decrease to $159,673, but still remained firmly in the positive territory. This stability is further reinforced by the 2025 figure of $105,027. These figures collectively demonstrate that the company has successfully navigated various market conditions and has consistently generated positive operating cash flows. This achievement underscores the company's financial resilience and ability to manage its operations effectively. The company's debt level has undergone significant changes over the past year. The total debt increased from $4,951,519 in 2024 to $5,239,439 in 2025, indicating a rise of nearly $288 million. This increase is largely driven by the principal amount of secured term loan, which jumped by 91% from $339.5 million to $646.8 million. However, not all debt categories have seen an increase. Collateralized loan obligations, net decreased from $1,766,104 in 2024 to $1,198,332 in 2025, indicating a reduction of nearly $600 million. Despite the overall rise in total debt, the company's interest expenses have actually decreased. Interest expense dropped from $412,913 in 2024 to $322,961 in 2025, while accretion of net deferred loan fees and discounts also saw a slight decrease. The decrease in interest expenses may be attributed to various factors, including changes in debt composition or refinancing activities. Nevertheless, the increase in total liabilities from $4,951,519 in 2024 to $5,239,439 in 2025 suggests that the company's financial obligations have grown over the past year. The management of the company is expressing a cautious outlook due to various challenges in the market. They are aware that inflation, rising interest rates, and increasing costs may negatively impact the value of underlying real estate collateral. To mitigate these risks, they have implemented measures such as hedging exposure to foreign currency and interest rate fluctuations through forward contracts. The company's strategy is centered around managing risks while providing attractive risk-adjusted returns. They are focused on monitoring credit risk, estimating fair value based on management's best estimates, and recognizing and measuring the allowance for credit losses under the CECL model. Additionally, they have a share repurchase program in place to buy back up to $100 million of their common stock. Overall, the company is taking a proactive approach to managing risks and navigating the complex economic environment. They are committed to maintaining liquidity while providing attractive returns to shareholders. The acquisitions made by KREF include investments in CMBS BPs, European loans denominated in British pounds sterling or euros, non-recourse long-term securitizations, and multifamily properties through deed in lieu of foreclosures. Additionally, the company entered into term lending agreements for match-term financing on a non-mark-to-market basis and originated or acquired commercial real estate loans held for sale. KREF also made significant acquisitions in the form of foreclosed properties recognized as real estate owned (REO) at fair value. These REO assets were classified as held for sale and sold to recover the carrying value or estimated fair value less cost to sell. In terms of divestitures, KREF sold certain real estate-owned assets, including a parking garage in Philadelphia, PA, and a retail/redevelopment parcel in Portland, OR. The company also modified several risk-rated loans located in Boston, MA, deemed them uncollectible, and wrote off the outstanding principal balances. Furthermore, junior mezzanine notes with principal balances of $25 million were written off in June 2024, while subordinated notes with a principal balance of $35.9 million were written off in December 2024. The company's financial activities have been marked by several notable transactions. One of these is the payment of dividends to its shareholders. This practice has been consistently observed throughout various sections of the report, with specific mentions on pages 14, 43, 44, and others up to page 140. The dividend payments demonstrate the company's commitment to rewarding its investors. In addition to paying dividends, the company has also engaged in share buybacks. This strategy involves purchasing a portion of its outstanding shares from the market, which can help boost shareholder value and reduce the number of shares in circulation. The report highlights instances of share buybacks on pages 59, 138, and 152, indicating that this practice is an integral part of the company's financial management. There are currently no significant concerns regarding inventory buildup or supply chain disruption. The report does not highlight any specific issues related to these topics. However, it does note that global tariff policies and escalating trade tensions may exacerbate existing supply chain disruptions. This suggests a potential risk, but one that is not explicitly addressed in the report. That concludes the financial summary for KKR Real Estate Finance Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.